Amid global worries over rising commodity prices, Nigeria's headline inflation has slowed down to 17.75% year-on-year in June, making it the third consecutive month that inflation will ease up. Inflation rate in May was 17.95%, which was 0.18 percentage points higher than the most recent figure contained in the Consumer Price Index released by the National Bureau of Statistics, NBS. According to data, food inflation, which has been the driver of rising prices in the past few years, reduced from 22.28% to 21.83% in June, while core inflation slowed down to 13.09% from 13.15% reported in May. The country's headline inflation rate had accelerated consistently for over 3 years, hitting 18.17% in March before a gradual retreat. Amid the drop in inflation, the Nigerian economy is still in a slump as food is still expensive for the poor and unemployment rate still stands at 33.3%, making life tough for about 105 million Nigerians living in extreme poverty. Now, it will interest you to know that a decline in inflation does not necessarily imply that prices are falling. It simply means that commodity prices are increasing, albeit at a slower pace. To discuss this and more, of course, issues surrounding the Nigerian economy with focus on inflation and what it means for Nigerians, joining us live from our Abuja studio is the lead consultant to ECOWAS Commission on Private Sector Development. He's also developed strategic framework for ECOWAS Private Sector Development and Enterprises Promotion, ECOWAS MSME Strategy, ECOWAS MSME Charter, is a tax leader advisor consultant with World Bank, DFID, NEPAD, ABR, FOA, UNDP, European Union, AFDB. I'm talking about Professor Ken Ife. Professor Ife, good afternoon and thank you very much for your time.
Oh, thank you. Thank you very much for having me.
Prof, let me ask with that layman's question. Inflation has declined for the third month consecutively, but many will tell you that market reality or what we see in the market is different from this. How do we balance these two reports or tally these reports?
No, obviously there's always a lag between when an action takes place and when it is picked up by analysts. There's always a 1 month lag, but be it as it may, I think we have a good reason to be optimistic because the slowdown is over 3 months period. And we are not actually saying that inflation has gone away. Inflation is all items, all indices, inflation indices, core index, headline inflation, rural and urban, and food sub-basket, all of them have risen, with no exception, except that they have not risen as high as they rose in May. So what you find is, if you look at the food sub-basket index, it has the biggest drop of about 0.44%. And that has influenced the drop across the whole 5 major sub-indices. You know.
So moving on, well, Prof, I want us to put this in a way that everyone watching us would understand clearly. Inflation at 17.75%. Now, what does it mean for someone that has like 1,000 naira? It means that definitely 1,000 naira cannot purchase what he used to purchase a month before. Can you please technically let us understand this more for Nigerians?
Okay, if you have 1,000 naira today and inflation is 17%, it means that in 12 months' time, that your 1,000 naira would have dropped to 830, something like that.
Okay.
So it's no longer going to be 1,000, you know, so it's going to go down, you know, all things being equal.
So clearly that's a good one. Let's now look at food, Prof. With all of the efforts in agricultural space, we know insecurity has also been on one side. Food inflation reduced from 22.28 to 21.83%. What are the fundamentals? What do you think is driving these figures with food?
Well, we are now in the transition period from planting season to harvest season. And then bear in mind also that just recently CBN released huge tonnage of grains. So you would expect that to enter into the market and cause some reduction in prices, the pressure. So, and then we're having early harvest. And when you have early harvest, you're also going to have to, you see the impact on prices. Prices will be slowing down. And the prices that are actually slowing down are the agricultural food basket. That is the farm produce. Remember, there are two components of that sub-index. We have the processed food and then the farm produce. The processed food is part of core inflation, because core inflation is all indices minus farm produce. So when you look at the relative drop in the inflation figure for farm produce and for core index, the core index, the drop is just around 0.1%, whereas the drop on the farm gate prices is about 0.4%. So what it tells you is that there is still rise in processed food in the price. So even though we are harvesting our farm produce, a lot of our imported materials are in the processed food as well. So the imports are driving prices high. And if you look at imports across all the indices, they are keeping the prices high. Whether you are in the rural area or even in the urban, you can even see that in the urban, the figure in the urban is higher than the composite index, the headline. So that also tells you that what goes on in urban area, especially the processed, imported processed items, are more intense, are more intensely consumed in the urban areas compared to the rural area. The rural is much lower. It's the lowest is the rural urban sub-index. And it also tells you the role of transportation. The transport cost pushes the price. As it goes from rural to urban area, the prices go up again. And in fact, even when you look at, if you disaggregate the data, if you take the headline inflation and look at the states, you see huge variability in the figures. In the states like Kogi State and Bauchi State, they are posting 21%, composite price index 20%, whereas states like Abia and Cross River, they are posting 15%. So you can see the average of the inflation figure is about 17 plus, but there are states that are posting 21%. And then there are some states that are posting about 15%, much lower. So you are now going to see a drive going down to 15. The tendency is for that 17 point to head down to 15 over this period that we are going to be harvesting up till October, November, yeah. So that's the tendency. And then if you look at the disaggregation of the food itself, the farm produce, you are going to also see the same variability that supports the theory of massive export of our grains in the northern frontiers, northern frontier states to our neighbors. You know, the big challenge that we have is that we are feeding 300 million people, not 200 million, because we are feeding the francophone countries that surround Nigeria, the Niger, the Mali, Chad, and northern Benin, northern Cameroon. They are heavily importing our grains and food products. And the reason they are doing that is, one, because they are protected by ECOWAS Treaty of Free Movement, where they don't pay tax or any quota on raw materials, raw food. And secondly, the price differential, the currency differential is so large. If 1 naira was buying 3 francs CFA in 2015 and is now buying only 1.2 francs CFA, effectively your currency looks about 70% devalued based on their own. And I can also have to tell you that that CFA is not really the true value of the CFA, because a lot of their reserves is pegged against euro. So a lot of their reserves are bonds to keep that price level of their currency. So, but our own is real because we are the ones managing our monetary policy. So our currency is the true value at any one day. But you can't say that for the people surrounding us. So there's an incentive for them to import our products into their territory. And then also, in terms of power per capita, they seem to be doing well because they can dry the produce they get from us and then bring them back much, much later, especially in the planting season. And they gain up to 100% increase in the price. So whichever way you look at it, we are the victim. And we're only the victim because we're exporting the jobs. Whenever we export raw material, it's jobs that we're exporting. If we are processing at world level, then they have to buy processed products. And they are buying processed products, they have to pay duty. Otherwise, they have to register for ECOWAS trade liberalization scheme. So this is the thing. That's the tragedy in our own side of these things, in this equation. We are not exporting our produce. We are not substantially adding value to them to extract those value by export. We are just not doing well enough on the value addition.
Now, Prof, what is more worrisome also is the fact that it's no more news. We know tomorrow and next will be Salah celebrations. And even ram sellers are complaining that they're not being able to sell as much as they used to sell. While we see almost 100% hike even in the price of the rams. We also see hike in the price of tomatoes, onions, pepper, like about 50%. Now, this clearly means that we have to pay more, but our purchasing power has not improved.
Well, without a doubt. But you see, the story about the food is a bit more complex because, especially when you are in a festive season, you have to look at a lot more things. And then you shouldn't be surprised that the lowest on the food was in the southeast and south, and it's because the food travels quicker outside the country from the northern frontiers. Can you imagine, would anybody from Niger import any food from the south? The travel distance will make it uneconomical for them. And then again, also notice that even though we have not shifted, the MPR rates have not been shifted yet, but the bank is in open market operation, is beginning to mop up liquidity. So we don't have that liquidity as much as you would expect. So if they are complaining about people not buying the rams, I mean, I wouldn't be surprised, because there's a gradual tightening now of liquidity. But you also have to match it with the high price. I was pricing one of the ram at 250,000 naira, almost at a price you can buy a cow. So I don't know.
Really, that's worrisome. You've touched on logistics and all of these challenges, but Prof, let's also move towards that angle of exchange rates pressure. That has also been one headache that we've had to grapple with. Now, it's a two-in-one question. How do you also see investors and traders, or investors and market reaction in general to all of these figures coming from the NBS? How do you see it affecting our projections as we move on?
I don't really see any much, because when already the inflation figure are on a downward trend, even the monetary authorities will be careful, tampering with the indicators, because you may use other backroom instruments, like, as I said, OMO, to mop up liquidity and going to play with the interest rates. Because there are people that you hurt when you play with those interest rates, and the savings rates are so low right now. But let me tell you something that can make a huge difference. If we have a rail network now connected up and goods can move very quickly, the cost of moving 1 ton of grain from Kanu or Katsina to Lagos is about 100,000 naira. But if you are using train to move it, it won't even be up to 5,000 naira. You know what I mean? Because a coach can take 30 tons. So there's no way. So that is one thing that could dramatically reduce all this pressure of inflation on the food supply. because of the cost of transportation. And then also, even though the petrol price has not actually gone up at the pump, but the roads are so bad that a journey that would have taken a day is taking 2 days. Sometimes it could take up to 3 because of security issues. Some they can only travel in the day. They won't want to travel in the night. You start and stop. So that's all increasing the price, impacting on the price. So rail transport will make a huge, huge difference in these inflation figures. Because if you look at the farm produce is about 8 percentage points away from core inflation and about 5% away from composite index. So you have to tame the farm produce to actually bring down inflation to the level that you've seen.
Now, Prof, poverty, people living below poverty line, that's also something that has been very worrisome. And we're talking about taking about 100 million people out of poverty. I think a committee has been set up for this and moves are already on. What right strategies do you think federal government and, of course, policymakers, what do you think need to be put in place to make this become a reality? If not 100%, 80%?
Yeah, you see, just under 5% of our population are in the big business, in the upper echelon. And then the proxy for middle class is the medium businesses. And then, where you have them at about 20 million, you want that number to grow to 40 million. Because if it grows to 40 million, then the top ones, which are the big business, will come to about 10 million or 10%. So, so we'll look at the scenario here. If the middle class pushes up to 40% rather than 20% that they are now, because 20% is about 40 million, then the top one will come down to about 10%. So 10 plus 40, 50% will be in that bracket. Now that will shrink the base. The base will shrink to about 50% rather than 80%, up to almost 80% that it is right now. So which means you have more trickle down from middle class rather than from the upper class. So that is where that's why we will say support the MSMEs, because they employ over 41 million people, 90% of the workforce. Any marginal increase in their size and in their productivity immediately mops up the poverty indices. The number that are at the base of the pyramid. So that is the thing, is the link. The link between the top and the bottom is very weak and tenuous. So that's where we need to, and if you transform that, look at the production system. There are 3 primary sectors. You have the agriculture, you have the industry, and then you have the service industry. Look at the balance, 22%, and then 18%, and then the other one is 54%. You can see that middle is weak. So the weakest point in our production system is the agro processing. So the moment you can process, you see that the manufacturing sector, this industry sector will come up, and the real balance and then the agriculture production will go down, because it should go down towards around 15%, so that the processing will go to about 25%. And then the other one will stay around 60%. That's the kind of balance that you have in an economy where a lot of people are employed, technologies are involved. After America, less than 4% are in agriculture production, and they can feed the whole world. So as more technology enter into that production system, the more you can produce, even though we have big security challenge in the 6 geopolitical zones. But the answer keeps going to quality food, with better technology, more intense mechanization, better yield and all that. And then once quality is there, this product can go out abroad. But if the quality is not there, they will simply hang around in the domestic economy, and most of it being exported to the neighboring countries. So, that's how we have to correct the balance and grow the middle class,
Prof, let's wrap up on this note. So you already touched on the MPC forthcoming meeting. So you don't expect anything. Do you think there'll be a shift or retention? That's looking at the meeting for 26th and 27th of this month. Let's wrap up on that note.
Well, the thing is that obviously there are all these views that that the money supply aggregates are also fueling inflation. Nobody doubts that at all. But the issue is to what extent? I have argued that the structural factors are more to blame than the money supply issues. But in order to keep some other field to other people happy, the bank, the CBN, is also using their instruments to restrain more liquidity. So it's doing that. So I would rather that they continue to do that than to go and tinker with the MPR rate right now. That's my own personal feeling.
All right, there's a good way to leave it there. I've been speaking to Professor Ken Ife, who's the lead consultant at ECOWAS. A lot of caps. He was consultant to the UN, UA, EU, AFDB. We can go on and on. Thank you very much for spending your afternoon with us this Monday, Prof. We really appreciate this.
Thank you for inviting me.
All right, there.